Welcome to Sense and Sensibility, the Inflation Guy podcast. I am Michael Ashton. I am the Inflation Guy, and I am your host. And do you smell that? Do you smell that? It's that new sponsor smell. We have a new sponsor starting with today's episode, and I'd like to welcome Simplify ETFs as a sponsor to the program. This episode of Sense and Sensibility is sponsored by Simplify ETFs. Simplify is a manager of alternative ETFs solving today's most pressing portfolio challenges. This includes income solutions like SVOL, S-V-O-L, yield curve plays like TUA, and 60/40 diversifiers such as CTA. If you are an individual investor or RIA, you will likely find that something they have done addresses a particular problem you have that you didn't know is solvable. Check out their website at simplify.us. That's simplify.us, and you can find their entire lineup of ETFs at simplify.us/ETFs. Really appreciate the sponsorship. Now, before we get into the program, I want to do a little of what we call in the biz cross-selling. I wrote a blog yesterday about how airline loyalty miles have become money, as opposed to, they used to be sort of buy five, get one free kind of coupons. But they've become money, and so I wrote in the blog about what that means for the strategy of keeping them or using them, and for what, because the strategy used to be one thing and it's changed to being now something very different. The blog is at inflationguy.blog, and I like that blog post. I should point out that the blog and this podcast, they're generally separate content. It's not like one is the mirror of the other, and although I have once, I did include a transcript of one of my podcasts, but, it isn't like I usually read an article I've written or have a transcript of the podcast. They're usually sort of independent and separate, except for the CPI report, of course, every month. So consider subscribing to both. They're both free, after all. Now, today we are going to talk about a topic that keeps coming up when people email me and when I'm on other podcasts, and we're going to talk about innovation and productivity. I've been asked a lot about whether the rise of ChatGPT and other forms of artificial intelligence means that inflation's a dead letter. We've reached the end of history. Inflation's going to shift forever. It's going to shift lower forever as the computers make us all more and more productive and eventually eliminate huge amounts of work from the list of things that humans have to do. And so in terms of output per labor hour, if I don't have to labor at all to do something, that's infinite productivity on those things. And so even if you have a few things that get replaced by machines, that could drastically lower inflation, right? Well, yes and no, I guess. We've had lots of examples of this over history, remember that, let's start at the beginning. Remember that real growth in economic output comes from one of two things. How do you make more stuff? Well, you either have to have more people working, increase the working population, or output per worker, also known as productivity, grows, or both things. If you care about overall growth, then either way of increasing output works. You can, open up your borders, bring lots of new workers, and that will increase your total output. If you care about standard of living, then you really want to see that's more closely tied to output per worker. And so productivity is basically the whole ball of wax. If you have, if you're making huge strides in productivity, you're making huge strides in the quality of life. I mean, think about, the invention of the plow or the cotton gin, which dramatically, all those things in the Industrial Revolution that dramatically changed the productivity of a worker, and at the same time dramatically improved the standard of living of everybody at the time. The Industrial Revolution was a time of a great leap forward in terms of the output of the average worker, but also a great leap forward in terms of the standard of living and the comforts that the average worker could go and afford. So we should really want the computers to take over. I mean, not like the Matrix takeover, but iRobot kind of takeover. Benevolent, tireless, genius slaves is what we want. Of course, if I'm tireless and I'm a genius, I guess I'm not sure why I'm happy being a slave. I mean, look at Jeff Bezos. But that's why that's why Isaac Asimov invented the 3 laws of robotics. If you're going to have benevolent, tireless, genius, and you want them to be slaves, you better code in there something which keeps them from, attacking you, because they don't want to be slaves anymore. Anyway, I digress. Let's look at some of the history of the growth of labor productivity in the U.S. Because when we think about AI and the latest whiz-bang developments, it's just another in a long line of innovations, right? I mean, I mentioned the plow, I mentioned the cotton gin, there's robots on assembly lines, there's the personal computer, there's the internet, and we can go on and on. The motor car, the aeroplane, all of these things were huge improvements. So let's look a little bit at the history of what actually happened to productivity, in over time when there have been other innovations. Now, quarterly measurement of non-farm business labor productivity in terms of output per hour is incredibly volatile. It's sort of hard to measure how many hours that we're putting in. It's kind of hard to measure the output precisely. And so if you actually look at, the quarterly productivity numbers, they're crazy noisy. So you have to smooth it, and you can't just smooth it for a year. You have to smooth it for multiple years. Oh, and by the way, they're subject to massive revisions over time. And so, you can have something which looks like a productivity miracle. 5 years later, it's all been revised away once we get better numbers. So you have to be a little bit careful of that. But so to get any sense of a trend at all, you have to smooth over 2 years or 5 years. I mean, if you look at quarterly changes, it's kind of like looking at a plate of spaghetti. It's just all over the place. So basically, output per hour, according to the Bureau of Labor Statistics, trended down from the late 60s, early 70s to the late 80s, early 90s. So the rolling 5-year average went from about 3% annual productivity growth to about 1.5%. So 3% meaning that every year for the same number of hours, we produce 3% more output, stuff, goods and services, okay? So we went from 3.5% annual productivity growth to 1.5%. That was a multi-decade trend. Then from about 1993 to 2010, it went from 1.5% up to about 2.8%. So it kind of almost did a round trip. If you look at the entire period from the late 60s to 2010, total productivity measured by output per hour increased, 3% at the end and 3% per annum at the beginning. And then in the middle, you were a little bit slower. But that's kind of the range, 1.5% to 3%. Since 2010, productivity has been trending downward, and the 5-year average is now something like 1.5%. So if anything, looking at that long term actually makes it look like productivity co-varies with inflation. So it goes down, it goes, up when inflation is going up, and it goes down when inflation is going down. So, the late 80s, early 90s, we had lowish inflation compared to the early and mid 70s, and productivity had gone from 3% down to 1.5%. So that's kind of going in the same direction. And again, reversing from the early 90s, to 2010, it kind of, I guess inflation was mostly stable there, and productivity went up a little bit, but then it's gone down since then, as inflation until the last year or two has been quite low. But it's hard to tell. I mean, these are big picture averages. And by the way, most of this is probably measurement error, because we don't have a good theory for why more productivity would mean more inflation. So that's probably anything which makes it look like they vary together is probably wrong. I'll talk more about measurement error in just a second. If you look at a 2-year average instead of a 5-year average to catch shorter term things, then you get it gets a little bit interesting in the late 90s. You start to get a jump in 1998, right when everybody started getting really excited about how the internet would greatly increase productivity as the computers became benevolent, tireless, genius slaves. The internet bubble, right? So the stock market boomed. So as an aside, you might see some reason why Wall Street really wants to convince you that AI is the next internet, right? Because it was really profitable, I mean, there was what it did for productivity, don't know. What it did for wealth of people on Wall Street, pretty darn positive, right? So, the shills were out in force back then, and so we need to be a little bit careful. We always need to be careful about the shills, but anyway, but productivity in the starting in 98 did go up until about 2003, and it's kind of declined ever since on a rolling 2-year basis. So that's kind of weird on its face, right? Why would we have a short-term spike in productivity for something as transformative as the internet? Well, the main answer is that transformative technologies represent step changes in output, step changes in productivity. They permanently change the level of productivity. They permanently change the level of output per worker, but they don't permanently change the rate of increase of productivity. Okay, so it makes perfect sense, right? So the invention of the cotton gin dramatically changed output in the harvesting and processing of cotton, as we moved from the old way to using the cotton gin. But once that had happened, then, that was a permanent change in how much cotton we could process. But then how does it's not going to make another step change, right? Because that's now fully incorporated. It didn't change the how much more cotton we would do every year after that compared to the prior year, right? So, if we were processing, I'm just going to totally make up numbers and even units because I have no idea how you'd measure this. But if we were processing, 1 hectare per hour, and then all of a sudden with the cotton gin we went up to 2 hectares per hour, and we're using cotton gin everywhere we previously used manual labor. Well, the next year it doesn't go up to 3 hectares because we've already implemented the cotton gin, right? So from that point on, you wouldn't necessarily expect that having the cotton gin will change the rate of productivity increase. And so you would get, again, tying productivity to standard of living, you would expect that the bump in productivity to be associated with a bump in the standard of living, but you wouldn't then expect that standard of living to continue to improve at that rate going forward. So it's really important to kind of not confuse the level and the rate of change effects when you look at technology, when you look at innovation, stuff like this. So transformative technologies, generally speaking, will increase your standard of living, but just once, not continually. Now, of course, it's not like once in 1 year. Like the invention or the internet becoming more and more widespread, is sort of a. It's not like the cotton gin that there's it's fully implemented after X hours, right, or after X years. it does take a while for that innovation to be fully realized or mostly realized. But still, most of the benefits are going to come at the beginning when you are first able to use a computer to solve the problem for your dissertation, the mainframe. The first time there are desktop computers, the first time that you have a cell phone now that can act as a mobile communications device. All of those things. Most of the benefits will accrue towards the beginning, and that's, like I said, that's what happened in the late '90s, as this boom in all things internet. It really was transformative. There were a lot of things that changed between '98 and 2003, and things have continued to improve since then. But it's gone back to sort of the old level of increase. The one-time effect is fairly short term, even for something as transformative of the internet as the internet. Now, there's also an argument to be made that we don't measure productivity very well, period. And in fact, that we're systematically bad at measuring some things that are really important, like intellectual property and medical care. And yes, I hear you, Steve. I know that's a point that you and I have been talking about for a very long time, and maybe I'll have you on the program at some point to articulate it better than I tend to articulate. But if we are systematically low on estimating productivity growth because we don't fully appreciate the value of that intellectual property, the value of how much medical care has improved, if we're systematically low on estimating those things compared to what reality actually is, it means we're going to systematically underestimate growth and overestimate inflation, which, by the way, is kind of the opposite argument that a lot of people make, that we systematically underestimate inflation. But the answer to that objection is the same as the answer to the guy who says that inflation is really 8% a year. Well, it is now, but it's been 8% a year since the early 80s. The answer is the same. There's no evidence that we are significantly, say, 0.5% or more per year, biasing our estimate of inflation too high or too low over time. And the reason we know that is that over a long period of time, like 30 or 40 years, even a small miss on inflation, if we were systematically measuring inflation too high or measuring inflation too low, it would mean a really big change in prices over time relative to incomes, which we measure pretty well. And so the standard of living that someone actually experiences compared to what the price index says you should be having would be dramatically different, because those little things compound quite a bit. I wrote a blog on this called 8th Grade Math versus Shadow Stats, I think is what I called it, on my blog. It's at inflationguy.blog. And I wrote that article years ago because I got tired of saying the same thing. But the argument is sort of the same with productivity. Do we measure it well? No. Do we systematically mismeasure some things like medical care? Yeah, definitely. Is it large enough that we are just systematically mismeasuring everything, and so we're just wrong about what growth is and wrong about inflation over a long period of time? The amount we're missing can't be that much, or we would see a much, 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 much bigger effect in the long run. So while we can't measure productivity very well, it seems unlikely we're wildly off over a long period of time. In some industries, like healthcare, then we probably are. But broadly, it doesn't look like it. So, ergo, despite the fact that in the last 50 years, we've seen the introduction of the computer, the home computer, and the internet, and now ChatGPT and other artificial intelligence, productivity has little spikes along the way associated with these big innovations, but then tends to return to trend and overall keeps plodding on. And that's what we should expect. Innovation happens all the time at a certain pace. Big innovations happen infrequently, but are assimilated in a fairly short period of time. So when you look at artificial intelligence, when you look at what's the value of ChatGPT, what's that going to do to inflation? What's it going to do to our lifestyles? The answer is, it's probably going to make, at some point, it's going to make some pretty big impacts over a fairly short period of time. When I say big impacts, I don't mean it's going to cause 10% deflation and throw 100 million people out of work. I mean, something akin to the internet, right? You're not going to really notice the effect. You're going to notice it in micro ways. You're going to know this person got laid off because, all he did was write thank you notes, and we can get ChatGPT to do that, whatever. So you're going to see little things like that, but you're not going to notice major changes all at once in entire industries. And similarly, you're not going to suddenly notice that your standard of living dramatically improves because of this. Because again, those are things that we would expect to be associated with each other. Is that a drastic jump in productivity should be accompanied by an equally drastic jump in our standard of living. And so we're going to see some of this, but it's not something that enters into my forecast of inflation. It's not likely to be big enough to hold down all the other forces and all the other forces that, by the way, have feedback loops. Like none of this productivity stuff has feedback loops in the same way that, higher inflation feeds into Social Security, which gives people more money, which feeds into more inflation. So anyway, that seems like about what we should expect from the rise of AI. Exciting, but temporary and not too terribly threatening. At least that's what my machine overlords told me to say. That's all for today's podcast. Thank you again to our sponsor, Simplify ETFs. You can contact me at inflationguy@enduringinvestments.com. Subscribe to the blog at inflationguy.blog. I mentioned that a couple of times in today's broadcast. Follow me on Twitter at inflation_guy, or visit Enduring Investments if you have an inflation challenge. Most importantly, defend your money. And if inflation is coming for you, remember, you know a guy.